Good morning, everyone. Nigel Baker here, and I'm here with Dr. Steve Garth, the chairman of our investment committee. How are you, Steve?
I'm very well, thank you, Nigel.
Well, it's a beautiful morning here in Sydney. We've both been lucky enough to get out for a swim in the water, very warm water, beautiful spring weather. But today we're here to talk about investment markets. And Steve, a lot of clients have enjoyed good returns this year. We're going to go through each market, but it's also interesting times because a lot of the economic data is contrary to what we're seeing in the market. So really great to have you on board today and explain what's going on.
Yeah, it's absolutely right, Nigel. It's been a fantastic quarter and a fantastic year overall. And you're right, markets just keep going up. They seem to be ignoring all the bad news out there, or maybe just the financial media trying to create bad news to get us all worried. Either way, when you look at the Australian market on this chart here, you will see back on April the 2nd, that big dip. That, of course, is when Trump announced the tariffs and markets around the world went down. Ever since then, markets have been an absolute tear, all of them hitting all-time highs, including the ASX 200. In fact, we talked about markets just don't care about bad news. They certainly don't care about tariffs anymore. They just see right through that. So over the quarter, been pretty good in Australia, 4.7%, and over the year, 10.6% for the 12-month return. That's really strong.
Yeah, very good returns. And we've seen some interesting movements in different parts of the market as well. Now, of course, we take a very diversified approach, but if you can run me through that, we've seen the financials come up and come down, and resources. What are you seeing happening there in the sectors?
Yeah, so in Australia, it is a concentrated market, as we all know, dominated by a few stocks. So I guess more importantly, it's just really dominated by two big sectors, financials, the big banks, and mining, in BHP and Rio. Now, you can see in the chart here that financials have had a pretty miserable quarter. That's because CBA is down by 10%. But financials have had a brilliant year, over 20%, because CBA was up so much the previous quarter. So that's really tossing that sector around. On the other hand, it's the reverse over in mining. They've actually had a miserable 12 months. And before that, they've been actually quite off for a while because iron ore prices have diminished. Chinese are not buying it. But in the last quarter, it's an incredibly strong return from mining companies, BHP and Rio in particular, and that's based on optimism around the improving Chinese market. So it really is a tale of two sectors, one's offsetting the other.
Yeah, interesting times. I think there was a band called Boom Crash Opera. They used to say, "These here are crazy times." And perhaps markets, it's always crazy, always unpredictable. So global markets, really fascinating. While we've had a good time in Australia, and of course most of our clients have a very good allocation to Australian stocks. Plenty of reasons for that, dividends, we don't have to worry about currency and that home bias that we naturally have. But global shares had a good run as well, and even better than Australia.
Better than Australia. In fact, over the 12 months, more than double what the Australian market made, incredibly. And you know, Nigel, for the past few years, we've been talking about how strong the US has been. But when you look at the chart here, it's actually across the board now. All the major markets, US, Europe and Japan, all returning close to the same. 23% in Aussie dollars over the full 12 months. And even the emerging markets, which have been laggard for a couple of years, they're up also at incredibly 23%.
Yeah, and China. I mean, China's been a bit of a slow market for a while. But
so China has not been going terribly well, and now suddenly it's on an absolute tear. It's up 20% in the quarter and 36% for the year.
And you're right, it seems like no matter what's thrown at the market this year, Trump, tariffs, today the US government was shut down. Now that's happened before under Trump, but also under Clinton, and it's happened, Carter, I think, closed the government down back in the 70s or so. When was he the president? So these events don't seem to be worrying the market too much. And I suppose from a client point of view, there's always that question of when will this come back and what do we do about that? And obviously we take a very diversified structure to that. But I think people do start to get concerned when we've just had such a good return, and that it doesn't matter what happens. The market, every morning you wake up and the Dow's up another 40, another 70, another 80. And of course we can't predict what's going to happen next. But it's just been fascinating, hasn't it? Really been so resilient. Yeah.
It's so resilient. You know, again, markets just seem to be ignoring bad news. And anyone who thinks that, I should get out of the markets now, they have to remember the old saying that markets can stay irrational a lot longer than you can stay liquid. And the meaning of that is, I know some of the economic news should say markets are, should correct, and they're not going to, and maybe they won't. Maybe they will. Markets just have their own mind, and we're certainly seeing a period at the moment where you should just sit back and enjoy what's happening, because there's nothing you can do. We can't predict the future. markets do go up and down. Staying disciplined in the long term, that's how you get the best results.
Yeah, we're really focused on that asset allocation and rebalancing. Now, cash rates have been coming down a little bit, so we're seeing that in the cash components, but bonds. Talk to me about the fixed interest markets.
Well, as you said, cash rates have been coming down, probably now on pause for a little bit in Australia. Even in the US, they've come down, but they're also looking now at slightly higher inflation, probably on pause. Either way, the actual 10-year bond yields, which very much are going to dictate how your bond returns are going to look like, they have been creeping down. Yields go down, prices go up. So you can see on the chart here that certainly for this year, it's been a great time in bonds. So not only getting a great return out of equities, the bonds are now doing what they're meant to be doing. They're providing a steady source of income, and we talked about, the markets might correct at some point.
Yep.
Bonds are still going to be that safe haven asset that when equities fall, then bonds should go up in value.
Yeah, and bonds are so important. I think a lot of people lost, a bit of faith in bonds in the COVID period. Of course, there's a lot of volatility, but now we're seeing where bonds really hold their own in a portfolio. They give us that liquidity. They give us what we call that point in time risk, where we can have bonds there to make sure that if there is a bit of a pull down, of course we can't predict that we've got plenty of insurance there, lots of protection in those bond portfolios.
Absolutely right, Nigel.
Great. Well, thanks a lot, Steve. Fantastic to have you here to help and explain these issues to our clients. Look forward to the next one.
Yeah, thank you, Nigel.